We're going to dig into a really fascinating idea from the book High Probability ETF Trading. We're talking about making a huge shift, moving away from trading based on gut feelings and scary news headlines, and toward a strategy that's all about cold, hard, historical data. It's a game changer for a lot of people, so let's jump right in. Let me ask you something, and I want you to be honest with yourself. What really makes you click that buy or sell button? Is it some talking head on TV, a breaking news alert, or is it a repeatable, tested rule that you follow every single time? If you're like most people, it's probably those first two. And that's a roller coaster that often leads to some pretty inconsistent results. The market is just an incredibly noisy place, isn't it? You've got this constant fire hose of information, so-called expert opinions, and economic reports all screaming for your attention. And let's be real, our brains are hardwired to react to that chaos, to that FOMO when things are flying, or that gut-wrenching panic when they're dropping. Trying to navigate all of that without a solid plan, well, it's a recipe for frustration. The authors of this book basically argue that your success really hinges on how well you can tune all of that out. So how in the world do you cut through all that noise and emotion? The book proposes a really powerful and maybe even a little counterintuitive solution, and that's what this first part is all about. The solution, a rules-based approach. This is all about making a systematic shift in your mindset from trading on what you think might happen to trading on what the data shows has happened over and over again. This quote from the authors, Connors and Alvarez, just nails it. You've heard it a million times, right? The key to real estate is location, location, location. Well, they argue that for trading, the mantra should be quantify, quantify, quantify. It's all about replacing vague feelings and, I think, with the hard evidence of the data shows. Okay, so what do they even mean by high probability? It's not some fuzzy concept. They put a hard number on it. For them, a high probability strategy is any strategy that, when you test it against historical data, has been on the winning side of the trade at least 65% of the time. It's a super clear benchmark. It's the line in the sand for deciding if a strategy is even worth looking at. All right, theory is great and all, but let's make this real. We're going to dive into a case study on a specific super simple strategy from the book called the 3-day high-low method. By walking through this step by step, you'll see exactly what a rules-based approach looks like in the real world. Okay, here are the rules, and I want you to notice how there is zero room for interpretation, no guesswork. Rule number 1, the ETF has to be in a long-term uptrend. They define that as being above its 200-day moving average. Simple. Rule 2, we're looking for a short-term pullback, 3 days in a row of lower highs and lower lows. If you see that, you move to Rule 3. You buy at the close of that third day. And the exit? Just as clear. You sell when the ETF closes back above its 5-day average. That's it. 4 simple steps. And here's what it looks like on a chart. This example from the book makes it crystal clear. You see the numbers, right? Point 1, that's the first day of the pullback. Point 2 is the second day. And boom. Point 3 is our signal to get in, that third consecutive lower day. And then you just wait. A few days later, you see point 4, where the price pops back up and closes above that 5-day moving average. That's our signal. Time to exit the trade. Okay, so the rules are clear, the chart makes sense, but this brings us to the most important question of all, right? The million-dollar question. Does it actually work? Is it profitable? This next section is all about the evidence. Let's actually dig into the data and see what the numbers say. This is the moment of truth. This is where the rubber meets the road for any trading strategy. It's where opinions and theories die and hard evidence takes over. So, what happened when the authors took this simple 4-step strategy and tested it across years and years of market data? Wow. Just take a look at that number. For the SPY, that's the big S&P 500 ETF, this strategy had a historical win rate of 87.5%. And that's over a 15-year period, from 1993 to 2008. That is an absolutely incredible number. And remember, it comes from just applying those 4 simple, non-negotiable rules every single time. And you might be thinking, okay, but maybe that was just a lucky streak with SPI. Nope, not at all. Look at these results across a whole basket of other major ETFs. The story is amazingly consistent. For instance, look at EEM, the Emerging Markets ETF, a win rate of almost 84%. But the really crucial number is that one at the very bottom. Across more than 700 trades in total, the strategy was a winner almost 77% of the time. Now that is the power of having a quantifiable edge. Now, after seeing those rules and those results, it's so easy to get really excited about this one specific strategy. But that's not actually the most important lesson here. And that brings us to our final and honestly most important section, the takeaway. Because the real lesson here isn't about one method, it's about the system itself. Look, the 3-day high/low method is really just an example. It's a vehicle to teach a much bigger lesson. The real takeaway here, the secret sauce, isn't this one set of rules. It's the power of the approach. It's about finding an edge, no matter how small, defining it with simple black and white rules, testing the heck out of it to prove it works, and then, and this is the hard part, having the discipline to execute it. It's about building a system to protect you from your own emotions. And that's what I really want to leave you with. This whole principle of quantifying your strategy can apply to almost any approach. So the final question is for you. I want you to look at how you make decisions right now. What is the one clear, non-negotiable rule that you could create today to bring just a little more data and a little less emotion into your own trading?